Today's pearl of investment wisdom comes from Warren Buffett's 2013 letter to shareholders, in which Warren Buffett highlights two investments he's made in the past. In 1986, Warren Buffett purchased 400 acres of farmland north of Omaha for $280,000, which he points out was a bargain because the bubble for Midwestern farmland just popped recently, with farm prices in the Midwest declined by over 50%. The second investment he goes on to talk about in his 2013 letter to shareholders was an investment in a New York retail property that was adjacent to New York University, which he made in 1993. Now, what does Warren Buffett have to say about these two investments, and what makes these two investments special, especially considering the fact that he's done hundreds of business deals and for a lot more money? $280,000 for a 400-acre farm doesn't sound particularly sexy or a mega deal for a man that's worth more than $50 billion. In the case of the 400 acres of farmland in Nebraska, Warren Buffett doesn't have a penchant for farming, and farming isn't one of his areas of expertise. But Warren Buffett does have a son, Howard Buffett, who has worked as a commercial farmer, planting soybeans and corn, and is quite knowledgeable about operating a commercial farm. Through consult with his green-thumbed son, Warren was able to get an idea what the operating expenses and the expected return from the 400 acres of farmland would be. With the information provided by his son, he estimated the farmland would produce a normalized annual return of about 10% with a future upside of improved crop prices and productivity. In Warren's 1993 retail property investment near New York University, Warren Buffett partnered up with a small group of investors, including Fred Rose, an expert on high-grade real estate investments, who along with his family would manage the retail property. Once again, through consult with trusted, knowledgeable sources, Fred Rose and others in the small group of investors, Warren Buffett was able to calculate the return on the retail property was about 10% with future upside due to better management, and at the time there were a couple of unleased stores at the retail property. Once those retail units had been leased, Warren Buffett expected even higher returns. Both investment in the 400-acre farmland and the retail property adjacent to New York University proved to be wildly successful. The farm has tripled its earnings and is worth 5 times or more what I paid. The annual distribution from his retail property investment exceeds 35% of our original equity investment, and several special distributions totaling more than 150% of what we had invested. These two deals highlights his thinking when it comes to evaluating an investment, be it a few $100,000 or a few billion. Warren Buffett points out that you don't need to be highly intelligent or possess a secretive knowledge to making rewarding investments. Warren isn't an expert in farming or commercial real estate, but he was able to draw on expert knowledge in both investment cases. Warren Buffett in his farmland investment, and Fred Rose and others in the small investment group in his retail property investment. Warren goes on to say that while it's not required to be super smart or even be extremely knowledgeable, you need to recognize your limitations and keep the analysis simple. Warren posited that regardless of interest rates or the political climate, soybeans and corn will still be planted in Omaha, and because the retail property was next to New York University, its future was bright because the university and students wasn't going anywhere. How many investors get way over their heads when it comes to investing in companies that they have very vague idea or even no idea what the company is doing or selling, especially new technology companies that promise to holistically empower and impact and synergize and globalize while disrupting and proactively leveraging something or the other. Warren stresses, if you don't feel comfortable making a rough estimate of the asset's future earnings, just forget it and move on. No one has the ability to evaluate every investment possibility. The business of farmland and retail property are easier to wrap your mind around than, say, microprocessors and biopharmaceuticals for the average investor. Another point that Warren stresses is examine what your investments actually produce and its future productivity. In the case of the farmland, it was soybean, corn, and other edible crops. In his retail property investments, it was rents, which Warren predicted would rise significantly because one significant tenant who was occupying 20% of the retail floor space was paying only $5 per foot for rent, while tenants around the retail property were paying $70 per foot for rent. Once that rental agreement was renegotiated, earnings on the property was expected to jump significantly. By focusing on what your investment actually produced and its future productivity, it will help you better evaluate your investment for the long term. With my 2 small investments, I thought only of what the properties would produce and cared not at all about their daily valuations. Don't get too sidetracked by macroeconomic issues such as interest rates or how the economy is doing or market predictions if the stock market will go up or down in the future. These issues are endlessly debated in the media and can cloud your judgment when it comes to evaluating your investments. As Warren puts it, my two purchases were made in 1986 and 1993. What the economy, interest rate, or the stock market might be doing in the years immediately following 1987 and 1994 was of no importance to me in making those investments. I can't remember what the headlines or the pundits were saying at the time. Whatever the chatter, corn would keep growing in Nebraska and the students would flock to NYU. Paying attention to daily market chatter and checking the prices of your investments can have big psychological impact, as investors get nervous when the market crashes and the world seems to be on the verge of ending, or euphoric when the stock market hits all-time highs and the good time seems to be never ending. Big market movements invites the chatter of market experts, financial planners, neighbors, and coworkers who feel like it's their duty to impart their financial wisdom onto you. Owners of stocks, however, too often let the capricious and often irrational behavior of their fellow owners cause them to behave irrationally as well. Because there's so much chatter about markets, the economy, interest rates, price behavior of stocks, etc., some investors believe it's important to listen to pundits, and worse yet, important to consider acting upon their comments. Thanks for watching this video. Hopefully you found Warren Buffett's investment advice useful. Please consider liking and subscribing to the Strange World of Econ channel, as it's a great free way to support the channel, so I can bring you even more investment advice from legendary investors. Till next time.